Good morning, everyone. I'm Vince Lancy, and this is the Goldfix Market Rundown. Today, we will be talking about the exclusive post we just put out, what India's Petro Yuan deal really means. And in the premium portion of today's chat or today's conversation, we're going to discuss the silver EFP conundrum. And we're going to try and spell it out so everyone can see what's going on and why this does not make sense. And there's something bigger going on. We hope to help everyone out with that. But before we do that, we want to address people are concerned that we're too dry or too analytical and that we don't know how to lighten up. So let's do that for you. Today, coming soon, exclusive, India's Petro Yuan deal, what it means, and the silver EFP conundrum, expert insights and chart analysis. Stay tuned. All right, here we go. There's the homepage. There's the story we're going to be talking about, top center. I'm sorry, that was yesterday's story. It's a very slow environment, isn't it? No, just kidding. Lower right-hand corner, exclusive what India's Petro Yuan deal means. And of course, we'll talk about the EFP in the premium portion of the program. Here's the markets. 10-year yields are unchanged bid. The dollar is up 17, 98.99. The S&P 500 is 675 minus 1. The VIX is 1652, up 23. Gold is 40. I don't even know how to say it anymore. $4,039. Down a buck. It was down about 20 bucks at one point last night. Silver 49.84, up over a dollar, butting up against $50. And I'm telling you that $50 resistance is just a Cheeto in a door jam. It's not resistance. Unless something changes, we'll find out in this conversation. That is a meaningless psychological number that people are hoping the market doesn't go above. Moving on. Copper up 12 cents, 2.5% almost. And that's continues to be the rally after Goldman Sachs upgrades their price target for it and implicitly silver. WTI up 13 cents. Natural gas unchanged offered. Bitcoin down 200, languishing. Ethereum starting to take a hit a little bit, down 3%. Palladium continues to rally, up $24, and platinum is down $4, taking a breather. Gold, silver down around 80, 81, and grains are mixed. Nothing special going on there. Soybeans are weak. All right. The story. India has begun paying for Russian oil in Chinese yuan, as reported by Reuters on the 7th. This marks a major step in global de-dollarization, a signpost, a crossroads, if you will, an intersection. The state-owned Indian Oil Corporation recently settled multiple cargoes in yuan, bypassing dollars and dirhams to simply trade and reduce conversion costs. The shift extends a framework first developed by Russia and reported by Goldfix as far back as 2017 that links yuan payments to gold convertibility through offshore vaults. With India now adopting this method, the BRICS bloc alternative payment network is operational, giving nations a credible gold-anchored path to trade outside of Washington's influence, translating to a further weakening of U.S. dollar global reserve currency status as we begin to see the new world order take shape in regional reserve currencies behind two halves of the world. We have that whole story for you, broken down what it is, what it implies, and where we're headed. Because it's kind of like the fruition of what we talked about in 2017, as picked up by Jeffries in 2023, and some plagiarists out there. You know who you are. And us now. All right, so I'm being a little bit snarky here. So that's it. That's an extremely important story. The world is split in two, collapsing complexity, fourth turning stuff, but there's an iron curtain going up between us and them. You got to have dollars over here. You got to have yuan over there. That's where we're going, unless we have some solution. All right. Related posts, gold breaks 4,000 as Goldman raises the roof to almost 5,000. That's our report. Thank you very much. Zero Hedge, Ross Norman. career long expert in the field who had his finger on the pulse back when he had Sharps Pixley of everything, and we used to read him zealously whenever he had anything out. And he's still positioned to understand these markets in a way that most people are not. And so we repost his stuff happily. Founders, Copper Critical 10,000 is the new price floor. We're going to have a breakdown of that report for premium tomorrow or Saturday, as soon as we catch up. And Gold Tops 4,000 is going to raises upside targets. That's the morning meeting, and Gold Fix PM. Those are all the posts together. Okay, let's stop right here. Before we move on to the premium portion of this program, I just want to give you an intro, a tease, if you will. I've spoken with industry professionals, refiners, traders, market makers, people like myself, people on the physical side at the institutional level, and kept my own counsel, having been through this before many times, more than I wanted to remember. And these type of situations, and I can say the following to anyone who's willing to listen. The EFP's persistent backwardation, which is now 120, reveals more about U.S. bullion bank priorities than anyone will admit. There is plenty of metal available in the United States and a shortage in London. Yet with spot prices trading $1.20 in silver above U.S. futures and no signs of tariff complications as of yet, not a single bank is closing the EFP to effectively get paid to ship the metal from the U.S. back to London. No one is doing it, at least not yet. Larger forces seem to be at play. I've seen this before. The last time I saw this, it was Warren Buffett did it in 97. I've seen it after Warren Buffett, but this is what he did. They threw a sheet over the metal. They said it's not available for shipping back to London. And little by little, boom, the market exploded. Who would be doing that? Well, maybe there isn't anyone doing that. Maybe it's just happening. Maybe the bullion banks just can't lease that metal back. Maybe they're under restraint. Maybe their business model, which is to make money arbitraging regions and regulatory, is not there anymore. Maybe the government is hoarding. You don't have to take a stake in JP Morgan for JP Morgan to work with you, because it's unpatriotic not to. And I mean that sincerely. So if this is a short squeeze, and it is, it ends with the pressure being released on the valve and the EFP going back up to where it should be, which is contango, meaning a little bit above zero. And it ends with metal becoming available and starting to flow again. Maybe people are waiting for news. Maybe there's things out of our control. But for a bullion bank who has a vault in London and a vault in the US, to be told, I will pay you $1.20 on top of shipping, on top of the fact that interest rates should cost you 50 cents to take COMEX futures metal and ship it to London, and no one's doing it, well, London is getting squeezed. I don't know if it's intentional or not, but London is getting squeezed. Okay, so stay with us. We're going to do the premium portion of this now. I'm going to go through the mechanics of this. Bob Coleman has been talking about it. I've talked about it many times in conjunction with the SLV lease, in share lease, and in conjunction with the lease rates in general. Many people improved metals. That's his tag. He's all over this because he's got Asian access, so he sees he's at the bridge. Those are all people worth listening to, as well as Chris Marcus, who's been on top of this. I'm going to go through this in the way that I've taught this in the past and try and make it a little bit clear to people that have the patience to understand it. Okay, so here we go. All right, so we're clapping, right? That's the end. Let's go premium now. All right, you're looking at the chart that reflects the spread between the most liquid front month silver future minus the spot price. So it's Right now, it's December silver minus spot. Now, in a normal market where there's plenty of silver around and you know where it's coming from, the silver future in the US trades above spot in London. In the world, it happens that way. Spot is the price. The futures are derived from the price, and the futures are higher than spot in precious metals because all spot is all the futures are is spot plus the amount of money you have to borrow to own it, plus storage cost, plus insurance cost. So it's opportunity cost. How much is spot? $45. How much is a future 1 month out? $45.10. How much is a future 2 months out? 45.20, 45.30, 45.40. And you create a yield curve, a term structure. Okay? So this is your market. I want to buy spot. I need to have $45 today, right? I want to buy spot a month from now. You need to buy 40, you need to have $45.10 a month from now. And that's your normal structure. And it applies to every commodity where supply is known above ground. But it's especially important in precious metals. This always holds true, knock on wood, in gold. And that's because this gold is that gold. There's no boll weevil. There's no crop failure. There's no planting season. It's gold. It's a pet rock. It's used for nothing. And that's why it's fucking perfect as money, because this gold is that gold. And the price of gold today versus the price of gold a year from now is gold plus time, plus money. That compensates you for the time. Interest. Silver is a different animal. Silver is also like gold in that there's no crop. This silver is that silver. All the silver created on earth is still here, but it's used. And so from time to time, like in energy, silver will have moments where it's like, I need the silver today, I need it now, right? And so the future is 45.20 and the spot is $45. And all of a sudden, I don't need the metal 2 months from now. I need the metal today. I have an iPhone shipment going out tomorrow. I have an EV being made tomorrow. And slowly, the cost of carry or the interest rate, the opportunity cost of owning metal becomes less important than having it in your hand now. Stackers understand this. And so what happens is this interest rate differential of 20 cents starts to decrease. This is contango. This is normal. And as you're running out of silver that's available for on the spot demand, that's why they call it spot, it starts to go like this. And now this should equal 20 cents because of interest rates, but now it only equals 10. So it's actually yielding more money than a treasury bill over this time frame. And then it goes to zero and it's yielding 3 times as much money as a treasury bill. And the market isn't arbitraging that. I did this. I arbitraged this. I mean, small, but I did it. Now the silver is over. Now you've got silver acting like oil. Now this has happened in the past. It happens from time to time for minutes, for hours, and for weeks once in a while, but not this extreme. Some examples if you want to research this: 97 when Buffett bought, 94 when Soros bought silver, um, during COVID. So this is a true short squeeze. As Daniel Golly said, it's the short squeeze you can buy into. It's a slow moving short squeeze. That other stuff we had before up in this area here, that was tariffs. That was this. That was here's the futures and here's spot. And the American future started doing this, going way above spot, too far above spot, because they're worried about tariffs coming in and driving it up. And if the tariffs did come in, this price would have come up afterwards, but they didn't. So the price went down again. And now it's this way because there's no fucking metal available in London. And if there's no metal available in London, as a good arbitrager, which I try to be, and as a bullion bank, which is their business of doing this, I say, wait a minute, I've got silver priced at $46. When I own it at $45, from here to there, I'm going to get paid $1 to put it on a bus and ship it over there. Done. How many? Okay. Now there's physical constraints to that, but the point is that's what they do. Now, are they literally shipping it over there? Sometimes yes, but what they do is they say, okay, this silver in the COMEX and this silver in London, they throw a sheet over it. They say this is now London silver, and the EFP goes like this. It goes back to normal again until the interest rate governs everything. But interest rates don't matter anymore when the collateral is in shortage. So why aren't the bullion banks closing the EFP out? Why aren't they saying free money? It's not like we don't have the silver. We have the silver. Why are we not sending it back? Well, you have to go through, as Tom Luongo likes to do, and I like to do, you have to go through who benefits and who suffers. Well, we know who suffers. London suffers. Well, why isn't someone responding and giving them the silver? Well, the silver is in short supply in London. The silver in the US is not in short supply. Why is the silver not being sent over there for the free money? Well, I'll give you some reasons. The first reason is this: it's not available. Why is it not available is your next question. It's not available because maybe we want to keep it available for our own SLV, which is what this really does. It pulls the silver into the SLV as people buy it. So as silver goes up, people buy SLV. You have to allocate more silver, which we used to pull from London. But we're not pulling it from London anymore. London doesn't have any to sell, to give us. And why are we holding on to our own and not bringing it back? Well, do we anticipate more demand in silver? Do we anticipate more SLV in silver? No, no, no. It's got to be more nefarious than that. As an American, I see China hoarding silver. I see India hoarding silver. I see a relationship with India on the rocks. And I just designated silver as a critical mineral, even though it's been a critical mineral forever, but I'm just making it official. And when you designate something as a critical mineral, the government doesn't have to ask to hoard it. It just hoards it. So if I had a relationship with a systemic bank like JP Morgan or other banks in that area, I'm not saying it's them, I would say to JP Morgan, as my broker, buy me a lot of silver. And JP Morgan say, fine. And don't make it available for lease. So this is a squeeze. This is exactly what Buffett did in 97. He took a delivery of a lot of silver. He let it sit there. And then when people had to have their leases renewed, he said, no, I'm not going to lease it. And the price spiked 40. It was a 40% rate of return in 1 year for him on the lease alone on silver. Now we're looking at, let's say 120% a year. It's over 10%, I think the lease rate is now. So now you combine this with things that people like Bob Coleman and Chris Marcus and Improved and Eric Young, all these people in our community that contribute to this bigger pie that I'm trying to build here, is this. When the EFP goes from spot to futures like this, well, that means you need to borrow metal to make delivery. You can lease it. I'm going to borrow your metal. I'll pay you some interest. But the lease rate goes up as spot goes above this. So the lease rate is nothing. And it becomes, well, I'll lease it to you for 30 days at 5%, at 10%, at 20%. So now you're paying 120% of the silver back monetarily 30 days from now. And so you're left with a situation. Do I just go in and take the silver from the COMEX? Do I just go in and find it somewhere else? Do I borrow it? Can I afford that? Or do I just get long and lock in my losses? Well, that's what a short squeeze is. Now let's move over to the financial side. On the financial side, you've got SLV, which is every time an SLV share is created, it's like a semi-closed end fund. Every time an SLV share is created, they have to allocate silver. Now, you can't get the silver out, but if you're big enough, you can. They allocate silver. Every time an SLV share is destroyed, that silver is pulled out. Now, the thing about SLV is, if I want physical silver, I can short the SLV and take that silver out and then commit it against COMEX. See, shorting silver shares in SLV reduces the amount of silver that has to be held. And so it's not just a short play, it's a physical short squeeze. And now SLV shares, I think, are up around 9%. You can't borrow them. If you can't borrow them, then another door to physical access is closed. This could end tomorrow. It doesn't have to end in Armageddon. Sometimes these things just they get bad and someone says, "Oh, I'll make a little bit of money." And they find the silver, you hear me say. But that's what's going on right now. So I'm going to draw you something very quickly so you can see what I'm talking about here. All right, so visually speaking, right? Visually speaking, this green line here, that's zero. That's zero. All right. So normally the EFP, this is a weekly chart. So we're really zooming out here. Normally the EFP trades with the futures over the spot. So it trades in this area here, right where that white line is that I drew. Now, when it goes up here, that's not always a problem. Sometimes it's just because of the rollover. So I want you to think that it goes like this. It goes up and down, up and down, up and down. But it almost never goes below zero. Now, this happens, but that arb is quickly closed. And this could be quickly closed again, but I don't see it happening right now. Now you've got the EFP down here with the market rallying. And that means someone says, spot, I need it today. I don't need it 30 days from now. Now, the December futures contract is September, October, November, December, right? So it's 3 months. So 3 months is if silver's trading $49 in spot, futures should be $49.20. Okay, 1 month out, $49.40. I'm making a number up, but this is how it works. $49.40, $49.60. So there should be a differential of approximately 30 cents between December and spot right now. But there isn't. There's a differential of $1.06 the other way. So not only is it $1.06 above zero, it's 40 cents above interest rates. So there's like $1.40 of free money in this, and no one's closing it. That's how contango and backwardation work. Until someone says, I've got the silver, you can borrow mine, that's going to happen. Now, why isn't the price higher? Because price is the last thing to discount physicality. You're hearing this because I've been in this industry for years, and in the past, I never had anyone to tell this to. And all I could do was just trade money and make money off of it. But now the world is different. And now, because of technological disruption, you can see this. But we're still in a bubble. It's a trader's bubble. It's bigger than it used to be, but it's still a bubble. And as time goes on, someone's going to release this valve. You have information that no one else has, that most of the traders on desks don't have. So what I'm saying is, don't think it's too late. I mean, it could get worse before it gets better, but it could also get better overnight. It could be another announcement. It could be, you know what, I am going to have tariffs. And I'm not going to get into it now, but I have seen this happen before in oil, in I think 1997. Basically, this sort of thing happened that we said we were going to tariff, we threatened to tariff, and the other country said, fine, then we're not going to send you any oil. So maybe London's saying, fine, I'm not going to send any silver. But it's really more like, why are the American bullion banks not closing this gap of free money? It's like there's $20 on the ground and they don't want to pick it up. Are they waiting for 30? Are they waiting for 40? Or are they not permitted to bend over to pick up the money anymore because their boss, someone else, is telling them what to do? I'm Vince. Have a great day.